welcome, peoples. It is Sunday evening in your world, and I'm going to jump in here. And this is a taxation. This is a little bit of the clickbait. It's earnings, dividends, tax free, in a regular account. I'm going to say this twice. This tax information is not relative to a tax deferred account, a 401k, an IRA, a Roth, etc. This is for US citizens' taxes. This is for anyone um, that is operating in an account where you are taxed, right? So a tax-free account, this is a reminder, while you're getting dividends and all that stuff, you're not paying taxes on those. You're not paying anything. The advantage of the tax deferred is you can keep growing the income. Sort of the bad news is once you start taking it out, like I'm at the RMD level where I'm forced to take some out, that's an age thing. You can look up I don't know what the required mandatory distribution. I don't know if the M is that or not, but that's what it is. So because I did an ROC video and I touched on some things, but in this one, I'm going to talk about just the overall context. Why am I doing this? Because I just filed my taxes or I prepared my taxes. I'm still waiting to make sure EOMax and some of the other funds where I own don't change their calculations, right? A lot of times they put out they're 8937 and you see that 19A1 or 191A. I don't have it in front of me. Um, and they give you estimates along the way. And then what happens, they provide to your broker and go by your broker's 1099. That's what you need to live with. Okay. And I'm going to refer to some of that when I jump in here. Otherwise, I think this is immensely useful if you're an American and you're going through other, Canada, they may have similar but different taxation. Excuse me. Okay. So, how in the US are you taxed and how should you think of it? Well, let's start with the basics. And I'm talking about whether it's dividend income, whether it's short term, long term capital gain. All right. So, gains are income gains or selling something. But let's just talk about qualified and non qualified income, dividend income distributions. Okay. What's the difference? Well, the big difference is how are they taxed? And I'm going to walk you through a scenario. And then we can talk a little bit about what qualifies them and everything else. But that's sort of on you. I can give you some real world examples of things that I've bought and gotten distributions in and grown my thing and how that impacted me and so forth. But there's not a one size catch all easy answer, but I'm going to tell you. And again, I'm not a tax professional. Let me say this out front. I've got a lot of experience. I've been doing my own taxes for 30 something years. I had a really good CPA when I was younger, and I watched what they did. And in those days, the software wasn't as sophisticated. And boy, I would take my statements in where I was trading some stocks while I was still working in my professional career. And the accountant was charging me their hourly rate. And I was like, oh, that cost me $600. I only made 2000 in my trade, so I'm never going to do that again. I'm going to do my own taxes. But and that was when you had the advent of the tax software, and that's gotten more sophisticated. Things are getting better. All right, so let's jump in here. So, qualified versus non qualified. Well, the US gives you somewhat of a tax loophole when you look at the qualified taxes, right? So, if you have qualified distributions, I'll give you a real world example. I had a lot of cash in PBR and PBRA. Don't worry about what the difference of those are. They're both um, what's the word I'm looking for? ADRs. You buy it in US, even though it's a Brazilian state oil company. And yeah, I know some of the risk involved in that. I was in it for several years, did quite well. And one year I was making almost a 50% annualized yield. Now that's back in the 19, but not bad for those of the income oriented. You have to be bullish on oil. You have to believe, and that stock's gone up and down, but kind of traded in a range. And if I'm not in it right now, but if somebody asks me, I think oil will do well over the next several years just through all the geopolitical issues. So you should be looking. Now, I know from firsthand experience they're qualified. Now, again, qualified has, look it up in the tax code, besides whether the corporation is, and you have to buy it on the US exchange, you start buying completely foreign, not even on the US exchange, you're going to run into some issues. The other small thing, like a PBR, and I own a South African natural gas company, they, even though it's trading on the US, there are some small income tax, 15%, some of them charge 20 that they withhold. Again, you can also deduct those on your US taxes against what you were, get. But the big deal is that they're qualified. But I learned that through chat boards and chatting other people, so before I got in. Sometimes it's hard to look that up. But I will tell you, many of the qualified go out to McDonald's, go out, and I'm going to walk you through all this stuff here. Very low yielding companies that are absolutely qualified dividends. But anybody who's in Yield Max and Round Hill and some of these other, you're not going to be happy with a Coca-Cola 2.86, you know, dividend yield. You're just not. And I get it. And yeah, it's qualified. So if you have millions and millions out there, it could add up. So that's qualified is a huge break. For instance, a single versus a married file jointly, right? So you get 2 for 1 here, but up to $48,350 in AGI, adjusted gross income. Okay. Then you're allowed to have that much when you add in your qualified dividends, and you owe zero tax. So it's a fantastic category in a way. So, what you're going to learn here as I get in, there'll be a third category that nobody really knew about that everybody's starting to talk about because now it's becoming more popular with the high yield funds. And I'll get into that in a minute. But let's go through the basics before we get into return of capital, which is a third category. And to me, the best of all, but there are some gotchas and there's some things that people don't fully understand. All right. So assume you had a $25,000 dividend payout that was qualified. All right. So whatever, you're going to find out and you're going to ask whether it's qualified dividend income or not. So let's assume it is. So the income level that you want to know is your adjusted gross income, salary, what are your expenses? Did you have an operation? Did you have a health care that exceed? Did you donate to your IRA, et cetera, right? So I'm taking somebody that's probably retired, has a low level of income, at least their adjusted gross income is say 18,000. So they're in high yield funds, whatever they're in, they're qualified. Okay. Typically these high yields are not qualified. They almost never are, but they use ROC. I'm going to get into that in a minute. So your adjusted income level was 18,000 before. Now I'm saying you made $25,000 in qualified dividends. So you add that to your 18, giving you 43,000. Your AGI is still below 48,350, so you owe zero tax on that 18,000. You're still going to be, and here's your tax rates down here for 2025. I realize if you're doing your taxes this year, you're dealing with 2024, but I'm showing what 2025 is going to be like. Okay. And then what I'm really hoping for anybody that falls into this, Trump has talked about wanting to have no taxes on your Social Security. I know for myself that when you add in dividend income, right? And I don't care if it's 80% ROC, which doesn't count as dividend income, but 20%, if you have enough of it, it's going to come in along with your Social Security and cause your Social Security to be taxed. That's happened to me. I know about it. So if Trump comes out and says, hey, whatever you're earning on Social Security, you paid into it, you're going to get that. We don't care if you have other income. We're not going to tax you on that. So that would save me some money because I do pull in a lot of income from my investments. Okay, guys. Again, not to try to confuse you. And again, I'm going to say this many times because I said it in my ROC, and in my comments, people said, "Oh, well, this doesn't apply to my Roth, or this doesn't apply to." Correct. You don't have to worry about what the tax is. But guess what? I say it again, when you do take your income, whether it's an RMD or you just decide you want to pull some out and you're already stopped working and everything, so there's no penalty, that income is taxed as just ordinary income. So if you go pull 100,000, it's just like you made 100,000, okay? Maybe without as much deductions. It depends, right? As to when you're working. But that's how it's taxed. The beauty is it's accumulating without having to pay the taxes along the way. All right. So in this case, so what happens if it's non qualified? So here's a perfect example, right? Here's your brackets, okay, for qualified and for non-qualified. So I take that 43,000, but remember only 25 of it was actually, whoops, this should be 25, not 18. 18 is what my AGI was before. So in this scenario up here, when I'm getting it to a qualified source, I'm paying no taxes. I'm still going to pay on my 18,000 AGI. I'm still going to be in the 12% tax bracket. So I'm going to be that in both of these scenarios, top and bottom. The difference is that 25,000, I'm going to owe 3,000 in taxes, okay? Plus whatever the 18, I mean, it's easy to calculate 12% of 18, it's around 2,000, right? Give or take. So you're going to owe 5,000 in this scenario, and you're going to owe roughly 2,000 in this scenario because you're hit with a 3,000 tax on the 25,000. Still not bad if you're making lots and lots of non-qualified income. That's why ROC is such a beauty, and I'm going to jump into that. All right. So I put these taxes in here. Now you understand what we're talking. Let's jump to ROC and show you good, bad, and indifferent. So this third category of tax rates, return of capital. Again, if you want to see, go look at my video that talks about it, but I actually dive deeper into a couple of nuances here. But if you just want to learn about ROC also, that video is good. I'll link it at the end. Okay. In some ways, ROC is the best of both worlds. Why? Well, it's like a big, giant tax loophole. Something that in the past was rare. This is increased. I'm talking about ROC now. Something that in the past was rare. Certain people were aware of it, but your average investor. But now with Yield Roundhill, Neos, some of the big guys, with these option strategies and other things that they're doing, they're able to qualify to do return of capital. Now, return of capital is a positive thing, and the tax treatment is brilliant. There are a little bit of a gotcha and something you need to know, and I'm going to walk you through that. But in general, they're really, really a good category. You should be very happy they exist. Okay, so let's walk, but it's also misunderstood and not fully known. Okay, let's walk through an example to help better understand ROC. So I'll cover what is ROC exactly and what is the tax loophole. How does it work? And give you a real world example and discuss any dangers, right? The gotchas to be aware of. All right. So why is ROC so desirable? Well, the tax treatment and the high yield dividends. Some examples of what aren't, right? Typically, ETFs that produce qualified dividends, okay? Not all, because I'm going to give you PBR, PBRA, and ZIM. I haven't bought ZIM, so I believe ZIM is qualified, but don't hold me to that. Do your research, okay? They're both high yield. And I can tell you with 2.5, almost 3 years in PBR and PBRA, I was extremely happy. Now, interesting, one of these is a preferred shares and the other is not. PBRA typically, in case you ever want to do this, I didn't, the first year I didn't fully understand that. So I just owned PBR. Well, PBRA was about 10% cheaper, but guess what? They both paid the exact same dividend. It's just that the A is considered, the voting and some of those things. But guys, unless you own 5% or greater or 10%, and look, it's a state owned oil company. Brazil owns the majority of the shares, and then obviously in the US market. So you need to be bullish oil in that scenario. And PBR is a fantastically run company. You can argue about leftist government. Are they going to socialize? Are they going to spend their share and hurt foreign investors? I've seen and heard all that. And you know what? It never really came about. Okay. It's a good 12 to 20% annualized yield. And whether you get capital gains or whether it grows is whether you're bullish on oil or not. Okay. Zem is an Israeli shipping company with very high yield. Both of these have long track records. Okay, so let's get back to this statement is generally true, but here's a case of PBR and PBRA, Petrobras Brazil, although you're buying ADRs on the New York Stock Exchange, they pay between 12 and 20%. So and they're qualified. In this case, I believe Zim is, don't hold me to it. Anybody that owns Zim can chime in. All right. So if you want 2 to 5% dividends, you're going to go out and you're going to buy ExxonMobil, Johnson and Johnson, Chevron, McDonald's, Coca-Cola. And look at these yields. They're nothing to write home about, right? They really aren't. But I get it. If you want qualified, very conservative. You might find some 90-year-old guy that's owned Coca-Cola and not Warren Buffett, but say somebody's wealthy and they got 6 million and they got it out there. A lot of times those guys will go into Yieldmax and they'll help them and say, okay, we're going to go conservative over here and we're going to do, and they're advising. I remember Jay talking about their advising service. And that's how these whole things have grown from only private equity people and very wealthy people to the average consumer. The problem is not everybody has that much knowledge. I see people dive in and go, I'm going to load up on Misty and I'm going to, get a Hilo on my house loan. And they throw everything and they buy it all at $45, right? It's going to 100. Hey, maybe Misty does at some point. Okay. But when it drops to 20 and you're on margin and you already borrowed all that money, it sucks. Very naive junior. I made every mistake there is to make in 45 years. How else do you learn? I didn't have a father that was an investor or didn't do any of that stuff. I'll talk later about my mom being in accounting and some of the things that she helped me with, and I'll talk later in that discussion. But these are your options, very inexpensive, very low yielding. Okay. So always look out for dividend traps where high yield stocks and ETFs have large NAV losses. If anybody's a regular subscriber to my channel, I talk about total return. Okay. What is total return? Well, total return is equal to what is the yield, right? What is my annual, if I want to compare it on an annual basis or whatever, that period of time, what is my percentage yield? 6%, 3%, 9%. Okay. Plus, I add it to my percentage of a NAV, okay, or a price gain or loss. So here is QQQY. I hate to pick on Defiance, okay, over the last year. And I just rounded it. I think it was 43, it was something. So there's a 45% decline in the NAV price on QQQQY, but it's yielding 11%. So somebody out here at McDonald's or Coca-Cola, maybe they're too conservative and for the very reason they don't want to do this. And they should look at it and say, guess what the total return of 1 year, the last 1 year in QQQQY? 34% How'd I get that? I added minus 45 to plus 11. Last time I checked, that was 34% negative, peoples. And sometimes people refuse. I get it. If I look at, well, I'll take you through when I go through my database of stocks. I'm going to show you an example at the end. So be aware that there are dividend traps. Okay. And I'm going to talk about um, yield on cost. Another thing that people love, but that can be skewed a little bit. All right. So non-qualified dividends often produce higher dividends. Fair to say, right? Greater than 8% to 20% plus. And for those of you that were in Coney and NVIDIA and Misty and some of the yield max, I mean, some of those things were just fantastic, right? I mean, I bought Misty at, you know, under 21, or rounded to 21, watched it go to 45. And I was looking at 2, 3 months in, and I had over 100% gain in the NAV price, and I was getting a yield that had an annualized run rate of excess of 150%. So I was like, oh, here we go. Well, it went back in time to $21, right? Which stocks do, which anybody will tell you you want a DCA, so direct cost average. Be careful. Don't just dive in all at one price. If anything, people learn that. So let's go in. Here's some examples. I got Spy Eye from Neos, JP Morgan, JEPI, and JEPQ. So they all pay monthly, okay? And we all know that there are now weekly payers. The weekly payers use the zero DTE or option strategy. So I should talk about that more. Those of you that know me from the channel, I used to analyze the yield max and several funds and all the daily stuff. It's just too much work, right? For my return back from my YouTube channel was not worth the amount of hours that I spent doing all of that analysis. And I can better just build my own database, select the stuff, and make a lot more money with my money. And so if you wondered why people, oh, can you do Amazon? Can you do this? Can you do that one? Guys, at a YouTube channel where I'm making $500 a month or something, it's just, it's a nicety. I'm doing it for the love of talking about this stuff and having 45 years of doing option and doing investment. I'm not like some of these young guys that jump out, have a full-time job, or they're wet behind the ears and they really don't have experience. But God bless them. I know some YouTubers that are 23 or 25 that are multimillionaires because of their diligence and hard work. It's not youth. It's just when you listen to somebody with real world experience for investment advice. If they're just reporting on what happened, anybody that's good, jump in and do that. I got accused of copying some guy that doesn't have half of my experience or anything. And sure, it should be treated as flattery if you make a spreadsheet and it resembles somebody else's and you keep modifying and doing it, which I have. But I was given hate and all kinds of things. But that, it's minor stuff. I'm mature, wealthy, and don't have any concerns about that kind of stuff. All right. So the option strategies can greatly accelerate returns in many of the high yield funds, but they also can hurt you. Okay. They may pay you monthly and some even pay weekly. I talked about the zero DTE, which means days to expiration. They basically write an overnight, if you will, for 1 day option. And you only can have 1 day options on the indexes at this point in time. I don't know if eventually an NVIDIA or a Tesla, or I shouldn't say NVIDIA, a Tesla or an NVIDIA or Palantir, or some of these really dynamic SMCI will ever get to daily options. They probably will, but right now it's the indexes. Enough people feel it's safer. All right. So regarding your typical taxation, you typically have two choices. I walked you through those, right? Low yields, 2 to 5%, low tax rates. Why? Because they're qualified, 0 to 20%. And 20%, you got to be making a lot of adjusted gross income, right? AGI, before you're going to hit the 20% bracket. It's easy to stay in the zero. And that's a loophole in itself. Okay. So the high yields, 8% and up. These are just numbers I picked, right? That, some people wouldn't say, well, it's not high yield unless it's 12%. And their low tax rates, what's 10 to 37%? That's when they're taxed as ordinary income, right? Those are the US tax rates going in to 2025. All right. So now let's enter return of capital. Okay, same thing, high yields, 8% plus, 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 right? Low tax rate, 0 to 20%. Remember before we had to go over here when we got high yields because they weren't going to be qualified. And these are not qualified dividends, but I'm going to walk you through how they get treated and work with ROC. So what's to not like with ROC, which is a higher yield and a better tax treatment? Remember, this tax advantages only last till an amount of dividends equal to your investment is returned. What the heck is Bruce saying? At that point, your ACB, adjusted cost basis, is equal to zero, and all dividends received would be taxed at a capital gain. Well, guys, tax at a capital gain is still lower than ordinary income. So let's go through this example. Say that an SPYI, I put 50,000. So that's, if I recall, that's a NEOS um, fund. So let's say that you put 50,000 in, and in the first year, it could be 100,000, it could be 200,000, it could be 25. Let's say that your dividends, and these were 12,000. Okay. So now this is 38. Okay. So I need to match these up. Okay. So this is a little bit on you. You need to keep track of your adjusted cost basis. I will say this, your brokerage at the 1099 level will do this. They may not show the adjusted cost basis along the way when you're looking at it, but that 1099 will get updated. But what I'm saying is you need to know when you're going to run out of tax free. And again, not all ROC is 100%. Some of these are just darn near 100%. Look at Yield Max. I went through my Misty, which was a lot of income. Those of you in Misty, was like 0% ROC. But Coney, many other ones, Tesla was 100% ROC. Tesla. I wasn't in it more than 3, 4 months, and I timed it pretty well. And so from that perspective, it was it was 100% ROC. So it all has to do with how the fund treats it and what they want to do. And there's no general thing that says, oh, Max is a 80% ROC. No, it's an individual fund. And they show you the 191A or A1, I think it's 1A. And those are estimates along the way. Then they put out an 8937 that says this is what we think it's going to be with all the monthlies added up. And then they give your brokerage the actual real numbers, which may or may not have changed. And then your 1099 dividends and so forth will reflect, okay, what the amount was. They may not give you the individual monthly breakdown, but they're going to say, okay, on Misty, this is, how much you owe, or this is how much income you had. So what happens here is this 50,000 with 12,000 the first year. Now you have 38. Well, you guys can see that if you get this high a yield, okay, you're only going to have 4 or 5 years shelf life before you're going to get your income to where it's taxed as capital gains. ROC is not taxed. Okay, I'm going to get into the next thing about, well, Bruce, is that too good to be true? But this is a little tiny gotcha that says, oh, I can just go forever and get ROC. If they keep putting 90% of ROC out in Coney or NVIDIA or something, then I'm not paying any tax on that. Okay. And I'll explain to you why you can only get down to zero and then it's taxed as a capital gain because there's no more to take. And most people then would sell. And when you sell, your capital gain is going to be on zero. So if you put 50,000 in, and I think I walked through that scenario. All right, let me just make sure I don't have anything down here. All right. So here's your capital gain scenario. Let's walk through it. Selling your position when adjusted cost basis reaches zero. SPY eye. So purchase price was say $45 in October of 2023, which was a real price, real trade price. So let's say that you hold it for a period of time and you sell it at $70 when your ACB is up, as an example. Okay. So you now have received dividends generally tax free, and now you have to settle up. So you don't have to, but you got nothing left. Now, there's one little technique that if you're reinvesting your dividends, that can be new money coming in. So if you're doing that, can extend the life a little bit of your adjusted cost basis. But boy, you talk about one that's hard to calculate. So that's an even harder. I'm not saying don't do it because that's always a good scenario. Um, so here's your capital gains tax rate. So your cost basis has gone to zero. And additionally, the share price has risen from 45 to 70. So you will pay long-term capital gains at a number of shares times 70. We didn't say if you spent 50,000 and you bought it at 45, you can do the math on that and say that, I got 1,200, whatever the number is, equals 50 divided by 45. Yeah. So I would have gotten 1,111 shares. Okay. But that's not so much relevant. The idea is the overall math. So you will now pay a capital gains, okay, on this. So we want to go through and say the sum of these two, whoops, times. So you now have a 77,770 capital gain. Now, capital gain rates are low. So you're going to go over here and you're going to pay at 15%. Now, I can't remember, people, if I don't have it in front of me, if you pay zero for the first 48 of the 77 and then 15 of the next. A lot of times that's how it works, but I could even be wrong on that. And it could just because you hit this level, you have to pay 15%. But honestly, it's not that much money. Long term capital gain rates. Let's do it right here. 11,000. So that's what you're going to owe, assuming that it's all at the 15%, all 77. Again, it might be broken across the tier in the first 48. You don't, but don't hold me to that. Again, that's why you have tax professionals and people like that. I'm not, but I do have a fair amount of knowledge, so I can discuss it. But I'm going to tell you when I know or don't know, which is this example. All right. So even worst case, 11,000 is not that awful, people, for something that, think about all that money that you earned along the way in those dividends and you didn't pay anything on. So this is sort of the comeuppance at the end, but then you're thrown in a brilliant long-term tax strategy, right? Because you held anything over a year is long-term capital gains tax rate. That's what these are. Okay. All right. So your cost basis has changed. Normally, you would have only paid capital gains tax on the increase from 45 to 70, which is 25. But since you did not pay income tax on all the ROC, you must now settle up. Okay. So note, this is an interesting thing. In the USA tax law, if you don't ever sell and you pass away, leaving your inheritance to a family member, whoever, they will inherit it as something that is known as step up in basis. So look that up if you care. If it's not relevant, then but I like to tell you nuances when I research and find them. Basically, the beauty of this thing is it reverts to market value and previous cost base is not relevant. So you're John, okay? John, for 7, 9 years, owned a high yield dividend income fund, and he gets his ACB down to zero. Maybe even the next year he pays capital gains. He passes away. He's 90. Okay, he leaves it to his granddaughter. Okay, his granddaughter gets that. Maybe it's a $200,000 initial um, investment that he put in, and he's all the way down to zero. So his tax basis is very large, right? All those captures, those ROCs, plus all the growth. Well, guess what? Susie, his granddaughter, she gets that at today's market price. She has no AC adjusted cost basis is zero. So grandfather dies, leaves it to her. The stock's now worth, $120 times the amount of shares. That's her cost basis. So she could begin a whole situation with a really high adjusted cost base, which is market value. So, but I guess I look at this and say, well, the government gets something. Is there an inheritance tax? It depends on how much. Again, I don't know a lot about inheritance tax law. Okay, guys, but I thought this was an interesting little caveat. All right, yield on cost. Some people say, oh, well, how do I avoid dividend traps? Well, what is it? Okay, I would rather still look at my total return. So what is yield on cost? Think of it this way. I got an example of Misty here, right? So you can see, remember I talked, Misty's just going to be a year. So it came out in March of last year at $20, whatever the close on the first day was, up close to 21. This is where I initially got in, okay? Rode this thing up and down and got out a while back, okay? So for me, my yield on cost, it's a simple calculation. And the logic says, what is it today? Is it better than another stock? Well, there's a lot of factors in that. So let's go through and say, okay, the last dividend paid by Misty, okay, which is in Group D, was paid on the 14th of February, and they paid 202.16, $2.216. Okay. And if you had all of the last 13 months, and remember when they're in groups, and they're in groups because the YMAX and YMAG pay weekly, so they're not a true month to month. They're more like 4 weeks. So when you divide 4 into 52, you get 13. So there'll be 13 distributions. That's why I did this number. So if you go through and calculate that, that tells you that in my situation, owning it at 21, my yield on cost is 9.63. So you go out and you look at one distribution and you look at what is my cost and you say, hey, my yield on cost is 963. Well, you could put a chart together of what it is currently. Every time you have a price, what is the last dividend? And then therefore, what is the yield on cost chart? So 23.27, if somebody, that was the close last Friday on 221, 23.27, well, I had the same distribution on February 14th, so the yield on cost there is lower. My yield is higher because I had a pretty advantageous purchase price. What if you bought right up here at either one of these? It zoomed up and you said, oh, it's going to 100, this thing's going to the moon, right? FOMO, 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 and you bought it at 45 and you don't want to sell it. You're trying to capture the fact that you're down in yield. Eventually, this thing probably will go above 45 again, right? When BTC runs again. And not only that, you'll get some great payments along the way. But that's why you typically are better to DCA. Because look at this. You have, here's a straight up channel. I always think of channels. If I draw a parallel line here and another parallel line here, I have a perfect downsloping channel. And then what do I have here? An upsloping channel. And now we're in a downsloping channel. So is this going to go down to 20 again? Probably. But is it going to go back to 45? Also, probably. And the third time knocking on that door, it probably breaks out and runs on up above that. Again, do we get a BTC, what is it, reserve or whatever they want to call it, where they put government money in that? I mean, there's a lot of things. I'm still bullish on BTC. One thing I don't believe in and do, or I don't know about it enough because you can only do so many things. You can be a jack of all trades, but you can't be a master of all of them. So I know people that love to trade meme coins and XRP, and this one's going to go when this goes. And, I just do BTC and I do it through these high yielding YBTC, Misty, different ones. I play Coney because I like Coinbase is going to make money by all those people that are chasing all the meme coins and everything else. So, I'm an old gold guy, but I'm not a gold guy that does not believe in what I call digital gold on the other side of BTC. All right. So this helps in understanding what yield on cost is. I won't say that it's bad, but again, it can be skewed. People that say, hey, that's the only way I'll ever do anything. All right, so let's jump in here. This I'm going to finish up with you guys and give you an example of something my mom taught me early on. And I miss my mom dearly. She's been gone for a number of years. So you can make what is total return? I talked about that. You can make anything look good depending on your sample size or whether you're truly comparing apples and oranges, right? Are you really comparing apples and apples, or are they really apples and oranges? So my mother, bless her heart, is probably smiling down on me as I say one of her favorite quotes. She went back to college in her mid 30s, having us four kids. I was the third, to get her accounting degree. That couldn't have been easy. I was a young kid at that time. So, under 10. So, did I, really have any sensitivity? Absolutely not. All I wanted to do was go out and play tag and Marco Polo in somebody's swimming pool. It was just, rambunctious, and I was a handful. So she worked in accounting and served on a credit union board. She loved that. And to this day, I look at my math skills. I have tremendous math skills. I can look at numbers and just see things that most other people can't see. So it comes very easy for me. And my mother was like that. People hated to play board games with me because as soon as they rolled the dice in Monopoly, I'd say, oh, you're over here in Marvin Gardens. And they'd say, well, wait a minute. I got to count them. I go, I already did. But, I won't blame them. They don't want to do that. But so some of us are gifted. It comes to music. I have zero. Love music. Have zero skills. Can't play any instruments. Can't sing to any tune. Don't understand it. Right. So let's jump over to one of my favorite tools. So, mother, I didn't finish it. She often used the quote, figures don't lie, but liars figure. Well, what does that mean? That means that you can take numbers, you can embellish the truth, or you can be 98% accurate, but you show it so that it looks best for you. I did it all the time in marketing. I was in technology, but I was in marketing and sales eventually after having been an engineer and programmer because there was so much more money in it. And I would always be the guy when I was a technician that they took out to the customer site because I would push the technology to answer the question that the customer had, and I'd embellish 5%. So I'd tell them 95% truths. So that because the question they asked, I knew what they were looking for. And I wanted them to feel comfortable so we would get a sale. And that's done every day, all the marketing and advertising. So I just want you guys to be aware, and I'm sort of the voice that can help you discern. Some of you, there's some brilliant people out there. I get comments all the time that somebody comes up and teaches me something or tells me. I'm never above that, right? So, but the hate mail, I don't know why I'm still getting the hate mail. I mention Trump or I say, hey, it's a current administration, so whatever they do can impact us financially just like the last administration could have impacted us financially. So stop with the hate stuff, okay? I mean, I'll try not to say political things, but sometimes they're going to eke out. But it's more about fiscal policy and what I think is going to happen is really where I'm coming from than sitting there bad mouthing someone or saying something positive. All right. So while mostly accurate, Yomax sent the following to my email below. So let's look at this. All right. Don't let our distributions distract you. Yield max ETFs also have pretty nice returns. Okay. So they come out and they say yield max has 13.87% total return. Now, see, they say nice returns and they mean total returns because they know if they come out and just say yield, they almost always have a higher yield. Just like I've done a lot on Curve and Yield Max. And Curve wins in total return about 5 out of 6, 4 out of 6 of the same funds, okay, with the same process. They're conservative. They typically pay half the yield that Yield Max does. But why is their total return higher? And again, if they're equal or curves 1% higher in total return, meaning their NAV loss is way less than yield maxes, but you're getting that big income along the way, then I see why somebody might choose yield max. But if I tell you the total return on, TSLP is 40% total return and on TSLY is 20%, why would you continue to invest in one that was half what the other was? Okay, even though the yield is paying more. So there's two components. So these are fair. My numbers are similar. They're slightly different. I'll show you in my database that I use a lot. FEPI, QDTE, XDTE. Well, they didn't include RDTE, but in some fairness, RDTE was 1 month short of being the full 6 months. I have them still at 744 missing a month of payments. Okay. And then one could argue that they haven't had a chance to appreciate or depreciate over an equal period of time. So I understand why they weren't included. Um, and these are index funds, right? These aren't, I can go out and show you, just like you guys, a million individual stocks. But I will say this, they didn't show the 3 month and they didn't show the 12 month, which I show in my database. Why? Because those are not good. They're barely positive. The 3 month is like 1%. The 12 month is barely, not even half of what these numbers are. Because normally, if for 6 months you're getting 1387, you can double that to get an annualized yield and say that's 27 when you add the 1387 and 1387 and call this 12, that's 24%. Those are really good yields. But all of a sudden when you look at 3 month or 12 months, so again, that almost goes back to the analogy of ROC, yield on cost. So where is it trending more than ever in these high yields? You have to watch when you buy in, and you have to monitor it. People that just say, I want to leave it and forget it, none of this stuff is leave it or forget it. And I'll say to people, another thing that I tell them, why would I just put like PLDTR, Palantir, my favorite stock. When I first saw PLTY, the Palantir high dividend yield income, right, using option strategy, I said they're never going to beat the underlying. They never, most successful high running stocks, you're never going to beat that. But people want the income, and I get it. And I even bit the bullet and bought into PLTY, although I own PLTR. But I bought it and I played it, and I just got out and I'm looking to buy back in on this gap fill going down. I did a video and mentioned that in one of them. All right, let's jump over here to my sheet. And here's something that I use this for. So here is how I like to look at it. So I have 1522 and 1369. So these two are clearly, I took the same QDTE, XDTE, and FEPI. Okay, they're showing 5 something, I'm showing 486. I also included, the reason I put it in yellow, RDTE. You notice it doesn't have a 12-month, and its 6-month yield is short by 1 month. So I went back in and I played with that, and I added 1 more month of distributions in there, and I got this up to 10 something. So it's about QDTE. So I will give it to YieldMax and YMAG that they won the 6-month battle. Okay. And they won some others, but look at the difference. Okay. Here are the yields. Okay. And 3 means 3-month yield, 6-month yield, 12-month yield. And then here's the NAV, right? What did it do? And did it go up or did it go down in the 3 months? And the same with the 6. So these are the best it gets. If I went out and said, yeah, YieldMax, how's your 3-month total return? 0.22, 1.98. All of these are negative though, but negative slightly, right? So QDTE is right there. And the other thing that YieldMax skewed this with, just slightly, most people would never know this, but they don't have the granular detail I do. YieldMax converted, okay, to monthly, or sorry, to weekly pay later than Roundhill did. Roundhill was paying weekly all along, and YieldMax through YMAX and YMAG, and that's when they created the Group A, the Group B, Group C, and Group D. And all of the monthly payers are still just paying once a month, but they're in a weekly group, so you feel like every week you get paid. That was brilliant marketing. I kudos to YieldMax for doing that. Okay, but what happened is that gives them, when they pick 221, a slight advantage because they had one more little payment in there when they used that date. So I will say that these are very close. Okay. And to me, I've seen Roundhill win sometimes, and I've seen YieldMax. So again, not knocking that, just trying to say to you, there's a lot more there. So let me give you some examples that I do, because in this one, I took all out. Okay, so now these are the kinds of things that I like to do to help and do my own analysis, right? So, what if I came in here and said, I want to look at 6 months, and what it does, it throws some blanks in above, but don't worry about that. All right, so let's go to the ones that are reporting. Well, what's the total best 6-month total return? Misty, right? 89.96. What's the 6-month NAV? 748. All the rest was in yield, people. So if you go, hang on, 8248 is your yield. And these are specific, these aren't annualized, right? You have to do that yourself with the 3, the 6, obviously. I do that a lot in my other sheets, but in this, I wanted everything to be equal. So you'll find somebody jump up. If I went here and said, who's been the best yielder, right? For the last 3 months? Well, let's do that. Tesla. Oh man, I want Tesla, right? 24.99. Now that is 75% annualized, right? Because you sorry, 100%. You multiply it by 4. 4 times 25 is 100. So you're talking about over the last 3 months, it's yielding 100% annualized yield. But look at the 3-month NAV, minus 27.53. So the 3-month total return is a negative 254. The 6-month is 23.54 because everything you look at in here, because I have it in 3 months, 6 months, and 12 months, the markets have performed better over a 6-month than they have over the 3-month and over the 12-month. Although the 12-month is still okay. So there is your total return for Tesla, 2870 in 12 months total return, right? And what's it made up of? It's made up of the 12-month NAV and the 12-month yield. So always those two numbers in here. So I find this, and I go hunting sometimes and try to see something that's broke out. Let's say I want to find somebody at my largest to smallest on 3-month trend. Who's trending right now? Hello, Babo. Have you seen it? I was telling my subscribers that I was going in K-Web about 6 weeks, 8 weeks. I had a couple of people say, "Oh man, get out of the Chinese. You don't want to be in Chinese." No, you want to be in some of the Chinese. They are trending. There's some good companies in there. They're undervalued. They've been overvalued at times, but they're fairly undervalued. They're getting closer to full valuation. So you've missed some of the run up. But this will point you to something that's starting to happen. But look at SMCY on the 6-month, right? Well, actually, the 3-month NAV is not that good. Oh, because I went off of total return. That means they're paying great money. Look at Palantir. Just before this thing dropped, this 3-month NAV was like 31% and the total return was 45, but it just dropped a lot, which I was already out of it at $90. I missed out. I mean, it did go as high as 95 for PLTY, but I knew that gap fill was going to happen. So I've been patient on that. And that gap fills about 71, 71 and a half, maybe 70.5, but I like to put it a little above because, it's nothing worse than missing. In my 45 years, I've missed things by a couple pennies by being exact and conservative. So anyway, guys, this is stuff that I do. If you like my channel, please subscribe. I love having comments. I love new subscribers. Let me know what else I can do to help you. I'm going to try and use this database that I have. I'm also going to update it in Google Sheets because I have to go get the prices now where I show current price, and that is automated, although at times it's glitchy. I've been playing around with it. All right, guys, again, this is Bruce with Targeted Wealth Creation, not a tax advisor, not a financial advisor, but hopefully you learn something more, some of the things to be on the lookout for. All right, guys, have a great, great rest of your weekend and good week, whatever that brings forthcoming. All right, bye for now.